Hi and welcome to the monthly FX update from us here at Audere Solutions. My name is Jeremy Thompson-Cook. I'm the Chief Economist and one of the Senior Portfolio Managers here. Q1 definitely ended with more of a bang than a whimper. The counterparty risk argument that we've seen hit markets as a result of the obviously bankruptcy effectively of Silicon Valley Bank, another regional bank going bust in the United States as well. And the whole issue around Credit Suisse and its eventual takeover by UBS made sure that haven currencies were definitely in demand as we headed towards the Easter break. Heading out of the Easter break now, as we move through the early part of Q2, we see three major risks to markets. One very, very macro, one a little bit micro, and one definitely currency focused. The macro one is what central banks will continue to do around interest rates and inflation. To be honest, it's been the story for the past 15 months or so. Average interest rates in industrialized nations are up around 1,600% over the course of that time frame, as far as the notional changes that we've seen from the zero or very, very low interest rate policies that we saw coming out of the COVID crisis. Now, in the grand scheme of things, those rates are not high by historical levels, but in the near term, they are much, much higher than they have been. And we are starting to see growth and consumer spending start to be choked down on. Now, these interest rate rises don't hit spending decisions instantaneously. There is a certain lag. Have these central banks gone too far, too fast already? Will further interest rates further choke off growth and put these economies like the UK, the US, the Eurozone into recession? We'll only find out over the course of the next 6 to 9 months, but certainly growth expectations and further gains for certain currencies are starting to look a little bit more in jeopardy, if we can put it that way. We do have a lot of central bank meetings over the course of the quarter. We do expect the Bank of England, the ECB and the Fed to continue to raise rates, but the language around those rate rises to change to one of maintenance as opposed to continual evolution. As far as the micro side of things, how businesses are able to continue to deal with higher wage demands from their workers. Workers are subject to, certainly in the UK, 10% inflation as it currently stands. But those businesses may not be able to satisfy wage demands. We're seeing strikes in the public sector, junior doctors on strike at the moment. But are private businesses able to do one of three things? Can they cut their margins? Are they happy to cut their margins and pay people more? Do they want to lay people off and maintain their margins? Or do they want to be able to increase their prices, or do they feel comfortable increasing their prices, further contributing to the inflationary environment which the Bank of England obviously has to continue to stamp down on? Sooner or later, this will lead to a point of inflection in growth terms, i.e. we will see negative growth, we will see moving towards a recession. That's going to be negative for a lot of currencies, but the currency that we're most worried about as we head through Q2 and into Q3 is actually the US dollar. The Federal Reserve is likely to be the first major central bank to cut interest rates. Beneficiaries from that will likely be the Japanese yen. We could see the euro move higher as well. Sterling's not going to do too much. But with our continual belief also from a commodity point of view that oil prices should remain high, maybe over $100 a barrel, NOK and CAD, major oil exporters within the G10, should trade over places like the New Zealand dollar and the Aussie dollar. What it means is more volatility, more risks for businesses of an international basis to keep an eye on. If you want further visibility of these risks, ways to mitigate them, or simply a look at how things are being costed for you on an FX point of view, feel free to get in touch. We are here to help. We're here to answer any questions you may have and be able to shine a light and add some transparency into a very, very murky world of dealing internationally. For now, thanks very much for listening. Look forward to speaking to you next month.